Hello everyone, this is CA Prachi Parekh. I'm an independent professional practicing in the area of direct taxes. Today we are going to have a look at some of the important direct tax proposals of the Financial Bill 2018, which was put before the Parliament on the 1st of February 2018. Let's move on to the rates of taxes. As such, there has been no change in the rates of taxes for assessees other than domestic companies. So the rates for personal taxation remain the same for this assessment year too. In respect of domestic companies whose turnover or gross receipts of the previous year 16-17 does not exceed an amount of rupees 250 crores, the tax rate has been determined at 25%. For domestic companies other than these, the tax rate continues to remain at 30%. Apart from that, there are no changes as such in the rates of surcharge. However, the secondary and higher education cess has now been renamed as health and education cess and has been increased to 4% from 3%. Moving on to some other provisions. Erstwhile, there was a provision under section 45(2) wherein conversion of a capital asset into stock in trade was covered. While a specific provision for this was in existence, there were no provisions to cover the conversion of inventory to capital asset. So the Finance Bill 2018 proposes to introduce provisions pertaining to conversion of inventory to capital asset. So suitable amendments have been made to section 28, section 224, that is the definition of income, section 49 and section 242A. Let us have a look at what these provisions have to say. The charging section of chapter 4D, that is section 28, has been amended to include that whatever is the amount on conversion of a inventory to capital asset shall be charged to tax under this particular head. The amount that will be charged will be the fair market value of the asset on the date of conversion. Consequentially, the definition of income has been amended to include the same. Further, when such converted capital asset is transferred, the cost of acquisition in respect of this capital asset will be the fair market value that was adopted for the purpose of taxation under the chapter 4D. Furthermore, it also provides that the period of holding in respect of such capital asset which is converted from inventory shall be reckoned from the date of such conversion. So the implication here is that even if we have been holding the asset as my business asset or as inventory for a period which is more than 3 years, when I transfer such a capital asset post its conversion to capital asset from inventory, the period of holding will be reckoned only from the date of conversion. So the assessee will probably lose out on the benefit of holding this asset for so many number of years as a business asset or as an inventory. That was about conversion of inventory to capital asset. Moving on to some other amendments. Section 9(1) clause 1 has been amended. This deals with the concept of business connection. Now, as we all know, business connection is a very ambiguous concept in itself given the taxation regime. So the explanation too that is there in the Act presently, which gives us some insight into what constitutes a business connection, has been substituted to include a scenario wherein an agent who is acting on behalf of the non-resident assessee has a principal role leading to conclusion of contracts will also constitute a business connection. What does this imply? Prior to this proposed amendment, the scenario was that whenever an agent was working on behalf of the non-resident assessee in India, a business connection was constituted only if the agent was given an authority to conclude contracts on behalf of the non-resident. However, there have been several instances wherein the agent does not technically conclude the contract, but he has a principal role to play leading to the conclusion of contracts. The widening of this meaning of the term business connection that is proposed by the Finance Bill 2018 will ensure that more transactions could probably now come into the meaning of the term particular clause of section 9 subsection 1, a new explanation 2a has been inserted. With the advent of technology and digitalization that we can see, what we now see is a person sitting in a remote or a distant location can have an economic presence in some other country. So the explanation 2a that has been inserted now states that significant economic presence of a non-resident in India shall constitute business connection. Now what is meant by significant economic presence? So the explanation further says, transactions in respect of goods or property, including download of data or software. Further, if there is a systematic and continuous soliciting of business activities, which is targeting a specified number of users, then both these terminologies will now come into the meaning of significant economic presence. And once a non-resident is doing this kind of activity in India, it will constitute a business connection. So the overall cumulative effect of substitution of the earlier explanation and insertion of this new explanation tantamounts to widening the scope of business connection. Further, it has been said that the amount and the number of users with respect to the meaning of significant economic presence will be later on prescribed. So we hope that wherein there are transactions involving minuscule amounts of money or a very limited category of users would probably not come into the meaning of the term significant economic presence, thereby constituting business connection. Now this widened scope of business connection is in line with the base erosion and profit shifting norms, as also the amendment relating to the agent is with respect to dependent agent permanent establishment norms which are there under the TTW. With the widening of the scope of business connection, one really wonders what would be the nexus of equalization levy in the scheme of things. Because as we all remember, equalization levy was something which the last Finance Act had sought to got into the Income Tax Act, wherein a levy of 6.5% was chargeable in respect of all these digitalization related transactions. So it really remains to be seen whether equalization levy will continue to remain in addition to the tax effect of this business connection or not. Time should clarify things. Moving on, in the speech of the respected finance minister, he gave a lot of statistics saying that as far as individual taxation was concerned, a majority of tax revenue was from salaried employees, and quite in comparison, a very limited amount of revenue was generated from business associates. So he went on to say that there is some relief that is going to be provided to the salaried class individuals. However, it looks more like a disguised relief, ek haath diya, something like that. So what has gone is the transport allowance, sorry for the typo in the slide, the transport allowance in case of other than differently abled individuals, which was at 1600 rupees per month, has been withdrawn. However, the transport allowance for differently abled individuals continues to remain. What has further gone is the proviso to section 17(2) pertaining to medical reimbursements up to rupees 15,000. So these two situations have been withdrawn, and in lieu of that, a standard deduction of 40,000 rupees has been introduced under section 16(1). Not much relief if we see, but then at least the headache of finding fake medical bills to actually add up to that 15,000 amount seems to have been taken care of. So these were about the amendments in the salary head of income. Let us randomly cover a few other important amendments of the Finance Bill 2018. There has been a change proposed to Section 43CA, Section 50C and Section 56 subsection 2 clause 10. So 43CA and 50C are technically deeming provisions, and the base of the section or the crux of the section says that wherever your sale consideration falls short of the stamp duty value, your stamp duty value shall be deemed to be the consideration in these cases. However, with the number of litigations going across, it came to the notice of the department that there might be a genuine case case wherein owing to the location, the size and shape of the plot, there might be a variation in the actual sale consideration and the stamp duty value. To mitigate some sort of litigation and to minimize the hardships caused to assessees, the provision seeks to state that no adjustments shall be made in case where the variation between the stamp duty value and the sale consideration is not more than 5% of the sale consideration. So if the difference between the stamp duty value and the sale consideration is within a margin of 5% of the sale consideration, there will not be any additions and the deeming provisions of these particular sections shall not be applicable. Some assessees used to take relief of a particular judgment in this case wherein the margin of relief provided was pegged at 10%. However, to remove the uncertainty and discretion with regards to these kind of scenarios, the Act is now proposed to be amended to peg the relief at a percentage of 5, the deviation that is from the sale consideration. Going further, some small amendments related to business income. Now, the major intention of these amendments is to align the Income Tax Act with the Income Tax Computation and Disclosure Standards, or ICDS for short. So the first insertion is in section 36(1), that is the general deduction. So clause 18 has been inserted which states that mark-to-market losses or other expected losses shall be allowed only if they are computed in regards to the ICDS as applicable. Another subsection has been inserted in section 48(3), proposed to be inserted. It says that no deduction in respect of mark-to-market losses other than those specified in section 36(1)(18) shall be allowed. Now, if you look at ICDS 1 generally does not allow mark-to-market losses. However, it states that if a particular ICDS is allowing the same, then give preference to that. So in respect of Forex or other ICDS wherein mark-to-market losses are recognized, this particular provision would be applicable, and now the Act has been aligned in line with the ICDS. Moving further, section 43AA has been inserted. It says that subject to the provisions of section 43A, any gain or loss on account of any change in foreign exchange rates has to be treated as income or loss, and the same has to be computed in accordance with ICDS. So this is again an attempt to align the computation of business income as given under chapter 4D with regards to the ICDS that have been prescribed. Now this particular section is subject to the provisions of section 43A, which means that when it comes to calculating of gain or loss in respect of foreign exchange fluctuations with respect to fixed assets that have been purchased, then 43A shall override the provisions of section 43AA. Further, it says that gain or loss shall be in respect of all foreign currency transactions, including monetary items and non-monetary items, translation of financial statements of foreign operations, forward exchange contracts, and foreign currency translation reserves. Moving further, a new section 43CB is proposed to be inserted in chapter 4D of the Act. It states that profits and gains arising from a construction contract or a contract for providing services is to be determined on the percentage completion method in line with ICDS. So, in this particular case, the revenue recognition will now happen in accordance with the percentage completion method. Going further, before we discuss some finer aspects of this particular proposed insertion, now 43CB further proposes that in respect of contract for providing services, if the duration of the contract is for a period which is less than 90 days, profits to be determined on the basis of project completion method, which normally assessees adopt. Further, if it involves indeterminate number of acts over specific period. So if the contract for providing services is in the nature that there cannot be an exact calculation or determination of the number of acts that have to be done in respect of that particular contract, then we have to spread it over the tenure of the contract, that is basis time, and therefore have to adopt the straight line method. Further, there is an addition which says, which is applicable both to subsection 1 and subsection 2 proposed to be inserted by the finance bill. It says that contract revenue in this particular case will not include retention money or contract costs, and they are not to be reduced by any incidental income, dividends or capital gains. Now, talking of contract for providing services to be, which is again a limb of this particular insertion, one wonders whether all service contracts will be covered here, or they would only be those service contracts which are ancillary to construction contracts. So there seems to be some sort of dispute or some probable disagreement that may creep in this particular clause. Moving further, section 44AE, which pertains to presumptive tax scheme pertaining to transport operators, has been amended. Until this proposed insertion, there was no bifurcation between the amounts of deemed income between the owners of heavy goods vehicles and other than heavy goods vehicles. So section 44AE now gives us, or rather proposes to bifurcate the method of computing revenue in respect of those assessees who are owning heavy goods vehicles. So the proposed amendment states that an amount equal to 1,000 rupees per ton of gross vehicle weight or unladen weight for every month or part of the month for heavy vehicles owned by the assessee will be considered. So from the amount of 7,500 per month or part of the month, which is the provision as on date, there has been an improvement to, there has been a change to amount which equals to 1,000 rupees per ton of gross vehicle weight. Amendment to capital gains. There are some interesting amendments that have taken place to the provisions of section 54EC and the capital gains chapter in general. We'll soon talk about the amendment in respect of 112, which is withdrawn. Amendment to section 54EC. Now we all know that section 54EC is basically a section for exemption of long-term capital gains. In this respect, any long-term capital asset which is transferred, the gain arising from this particular asset can be invested in specified instruments as specified under the section, and there is a lock-in period of 3 years in respect of these investments. Earlier, this particular gain could be from any asset. The proposed amendment now states that section 54EC exemption will now be restricted to capital gains from transfer of capital asset arising from capital asset being land or building. So if at all there is a transfer of any other capital asset other than land or building, any capital gain arising on transfer of such asset will now not be eligible to avail the exemption under section 54EC. Further, the lock-in period of investments, which was erstwhile 3 years, is now proposed to be increased to 5 years. Mediclaim insurance under section 80D. The limit in respect of mediclaim insurance premium, medical expenses, also expenses incurred on preventive health checkup, has now been increased to rupees 50,000 from rupees 30,000. Further, the differentiation between very senior citizen and senior citizen has been withdrawn for the purpose of this section. Apart from these two changes, there is a new subsection which is proposed to be inserted, which is in line with the new type of health insurance policies that one can see coming up in the insurance market. So what does the new provision has to say? It says that where any amount is paid in lump sum to keep in force a health insurance policy which is for a period pertaining to more than 12 months. So the health insurance policy is going to remain in effect for a period which is more than 1 year. A deduction in respect of this premium which is paid in lump sum shall be allowed, and this deduction shall be equal to the appropriate fraction for each of the relevant previous year in which the policy is in force. Section 80 DDB, this pertains to expenses incurred in respect of treatment for certain ailments or specified diseases. The earlier limit of rupees 60,000 for senior citizens is now proposed to be increased to rupees 1 lakh. Further, just as in the case of section 80D, the differentiation between senior and very senior citizen for the purpose of this section has been withdrawn. Let's go on to the big ticket change that has taken place in this particular bill that supposedly caused a bloodbath in the market. That is the insertion of section 112A and modifications to the erstwhile section 112. Now section 112 deals with exemption in respect of long-term capital gains in respect of a listed equity share or an equity or a unit of an equity-oriented mutual fund. Under the erstwhile provisions, this gain was exempt under section 1038. Let us see what the new change has been proposed. Capital gains arising from long-term capital asset being equity share in a company or unit of an equity-oriented fund or unit of a business trust. Furthermore, the equity share should be such that securities transaction tax should have been paid both at the time of acquisition as also at the time of transfer of such particular asset. In case of unit, STT should have had been paid on the transfer of such capital asset. Now what happens to the capital gains in this respect? Such capital gains shall now be liable to tax at the rate of 10% where the amount of such gain is in excess of rupees 1 lakh qua assessee. So when this provision was announced, there was some confusion with respect to calculation of this limit of 1 lakh. So it is qua assessee. These particular capital gains have to be computed without availing the benefit of indexation. Further, all long-term capital gains up to the date of 31st January 2018 have been grandfathered. So, for that purposes, whenever such a capital asset is acquired prior to 1st February 2018 and it is subsequently sold, the cost of acquisition for that capital asset will then be higher of 1, that is the actual cost of acquisition, and 2, that is lower of fair market value of such asset or full value of consideration on the transfer of this particular capital asset. So this is all about the change that is proposed to be inserted in section 112A. With this, the exemption under section 1038 has been omitted with effect from 1st April 2018. Also, there might be a scenario wherein certain equity shares which have been acquired long ago by the assessee, and they could be belonging to a period wherein the payment of STT was not a norm. So, the bill further says that in respect of such specific kind of acquisition of such equity shares, they will notify the mechanism in which the gain has to be calculated. All other provisions which are similar to section 112 remain the same. That is unutilized basic exemption limit the assessee can avail. Of course, it is restricted to resident individuals and HUFs only. Rebate under section 87A shall be allowed from the income tax on the total income as reduced by tax payable on such capital gains. Also, Chapter 6A deductions will be allowed from gross total income as reduced by such capital gain. Moving on to the next big amendment that one can see, there is an amendment with regards to the taxation of deemed dividend under section 222E. Now we all know that the provisions of section 222E have always caused abundant litigation as far as the tax laws are concerned. There was a lot of ambiguity about in whose hands the amount should be taxed. whether the recipient, whether shareholder or the company, to harmonize all these confusions and to bring clarity. The Act now proposes to state that deemed dividend under Section 222E, that is applicable in respect of closely held companies, will now be taxed at a flat rate of 30%. Furthermore, this amount of tax on this dividend will now be paid by the company in the form of dividend distribution tax under the provisions of Section 115O. So, no longer will there be a dispute about the incidence of taxability with regards to this dividend. The Act now proposes to make things clear, and this dividend will now be taxed under Section 115O. Last amendment before we close this part of the video, that is in Section 115BBE, which deals with unexplained investments, expenditure, etc. That is all the provisions of Section 68, 69A, 69B, 69C and 69D. In subsection 2, after the words clause A and clause B is proposed to be inserted by the Finance Bill 2018. The implication of this particular insertion is that no deduction shall be allowed in respect of any expenditure or allowance, even in respect of the income which is determined by the assessing officer under the aforesaid sections. Thank you.